Alright, so in this video we're going to look at the material in the that kind of covers the first half of Lesson 13, Money and Banking. Um, so we're going to first just define simply what money is. And it seems kind of a silly question to ask, what is money? Because it's kind of like, duh, obviously it's the coins and the bills that we carry around in our pocket. But more generally speaking, when we talk about money, we say that a basic definition of money is anything that is accepted in exchange for goods and services, or anything that is accepted as payment of debt. Okay, so obviously, if I want to buy goods and services, I use, my debit card, which is tied to money in my bank account, or I use, the cash in my pocket. But it doesn't necessarily have to be what we, use as money to be considered money. Now, throughout human history, people have used all sorts of things as money. So, most obviously, gold and silver. They may, carry around gold, just nuggets of gold or bars of gold, or they may take that gold and stamp it into, coins. The thing about gold and silver is that it's a representative, or it's an example of something that we says has intrinsic value. And there are many things that have been used as money that have intrinsic value. So gold and silver, for example, obviously, in and of themselves, they're shiny bits of metal. They look nice. We can make nice things out of them, jewelry and sculptures. But also, they have chemical and physical properties that we can use in things like our smartphones and fancy electronics. So if you've got a smartphone, there's a little bit of gold and other fancy metals in there. But these are also things that we've used as money. Now, some other things people have used throughout history. Salt, for example. So in parts of Asia, they used to use salt as a form of currency, and so you'd walk around with little blocks of salt instead of paper money or coins. Seashells, even further back in history, people might use seashells as a form of currency because they know they could exchange it for a good or service, and then you might receive it for a good or service, and then you knew you could go in and use it to purchase something from somebody else. Now, in more modern times, there are other things that have intrinsic value that we see used as money, and in particular, in certain institutionalized populations, so groups of people that are cut off from the rest of the world, they find things to use as money. So in prisons, we if you watch TVs or movies, you may have seen prisoners using cigarettes as a form of money. Now, the intrinsic value of a cigarette is that it's produced to be smoked and consumed. But if I know that I can trade my cigarettes to somebody else, for another good or service, then maybe if I've got something to swap, I'll say, hey, I'm going to swap this to you. You give me the cigarettes, and then I can use the cigarettes to go get something from somebody else. So it's a form of bartering, trading one thing for another. But what really makes it money is the fact that it keeps getting passed along, right? More than one person is going to be willing to accept it as a form of payment. And even more recently, there have actually been documented cases of prisoners using canned sardines as a form of currency. Again, canned sardine, its purpose is to be eaten. It's preserved food. Because it lasts a long time and you know that maybe somebody else is willing to accept it, so you'll accept it, again, it starts to function as money. So there are lots of things throughout history that people have found and used as money, but also have some other original purpose, some intrinsic value. So the currency that we use today, the bills and the coin, is what we refer to as fiat currency. And so fiat, F-I-A-T, is a little Latin word, and it simply means a decree. And so to make a fiat means you decree something to be true. So with fiat currency, what we're saying is that a government decrees that something will be used as money, right? So our federal government prints up the bills and it mints the coins, and it says, we decree this to be money, all right? Now, it's not quite as simple as that. So a lot of people say fiat currency, it's only valuable because the government says so, all right? And that's part of it, but not all of it. What government really is interested in is its ability to purchase goods and services in the future, which means it has to determine what is it going to accept in payment of taxes. So fiat currency, in part, gets its value not just because the government says so, but because the government says this is the only thing you can use to pay your taxes, right? So imagine trying to go and pay your taxes with some salt, or they might accept gold or silver, but you're probably going to have to sell that first. But try walking into the tax office and paying for your taxes in cigarettes and canned sardines, right? They're going to look at you like you're crazy and ask you to come back with money. So money that has intrinsic value versus money that is a fiat currency. The money we use is a fiat currency. But again, that doesn't mean it's the only thing that might be accepted in certain populations. Even more modern development, Bitcoin, right? It's not a fiat currency because it's not, someone decreeing it to be currency. It's not issued by any government, right? It's a decentralized form of currency. But the fact that some people are willing to accept these bits of code in payment for goods and services makes it money. Okay. But it's money that, again, doesn't have any intrinsic value because Bitcoin is created to serve as money. All right? So it's kind of in between, a pure fiat currency and money that has intrinsic value. So that's what money is. And then we want to talk about, well, what does money do for us, right? What are the functions that money serves? And what problems do these help to overcome? So the first function of money is in our definition, right? It's a medium of exchange. It's what we use to buy and sell goods and services. Now, in the absence of money, what would we have to do? Well, we'd have to engage in bartering, which means we would have to trade one thing for another. And so in that quote from Adam Smith earlier in the semester, he talked about the butcher, the brewer, the baker, right? Well, if they don't have money to buy stuff, they're going to have to trade bread for meat, meat for beer, beer for bread, right? They're going to have to all engage in these bartering transactions. Now, bartering might not be so difficult, except for one problem. You're only going to be able to barter with someone if you have something to offer that they want, and they have something to offer that you want. So we refer to this as the double coincidence of wants. So in our example of the butcher, the brewer, the baker, you may have the butcher who provides meat and the baker who provides bread come together and try to trade with one another. Well, if they're forced to barter because there's no money, we're going to have to assume that the butcher wants bread and the baker wants the steak, the meat. Well, what if the baker's a vegetarian, right? Well, it doesn't matter how badly the butcher wants the bread, because the butcher doesn't have anything to offer the vegetarian baker. That transaction is not going to happen. Well, when we introduce money into the transaction, right, now it doesn't matter what the butcher has to offer, because as long as the baker is willing to accept the money, right, the butcher can pay money to get the bread, and then the baker can take that money and go out and buy tofu or something. Okay, so medium of exchange that helps us avoid having to barter, and it eliminates that problem of the double coincidence of wants. So that's our first function of money. The second function of money is that it serves as a unit of account. And so recall when we were measuring GDP, we said it's the market value of goods and services, and it's the price, and it's a price that we measure in money. All right, so what we're doing is we're looking at all the goods and services, and we're accounting for their value in the same unit. Okay, we're pricing everything in terms of dollars. Well, what if we didn't have money? What if we didn't have dollars? Well, the butcher would have to figure out, okay, I have a pound of meat, and I'm going to sell this pound of meat to the baker for 3 loaves of bread. So that's one price, 3 loaves of bread per pound of meat. But then when they go to the brewer, they're going to think, okay, the same pound of meat, but now it's going to be exchanged for beer, and so maybe the pound of meat is going to be worth 2 bottles of beer, right? So that's a different price. 3 loaves of bread per pound of meat, 2 bottles of beer for the same pound of meat. That's 2 prices for the same thing. Okay, so imagine, if you have an economy with many, many goods and services, and every good or service is going to have to be priced in terms of every single other good and service. Right? The number of prices that you would have to calculate is going to increase exponentially. But by introducing money and by measuring everything in the exact same unit, that means for every one good or service, we have one price instead of many prices. And so what that then is going to be able to or help us to do is to make very quick and easy comparisons between very different goods or services. So you may try to, without money, assess the value of an apple and an orange. You can say, oh, well, they're kind of fruits. They're both sweet. They're about the same size. But there's differences between an apple and an orange, right? In terms of, its value, its intrinsic value. But in terms of its monetary value, we can slap a price on it. We measure them both in dollars, and we see, okay, an apple is 50 cents and an orange is $2. So that orange is more valuable than the apple as measured in this common unit, this unit of account. So that's the second function of money. It serves as a unit of account. It helps us reduce the number of prices to be calculated and helps us to compare the value of different goods and services. Now, the third function of money is that it serves as a store of value. So I could give you $20 right now. You could put it in your pocket. Maybe it falls out of your pocket underneath the car seat, and a week later you find it. Well, it's still $20, right? That token, that bit of money, that physical bill or those coins, right? They store their value over time. Now, of course, the only problem with our money is that over time, it tends to lose purchasing power as prices rise. So maybe money isn't the best store of value. So maybe we take our money and we go buy stocks or bonds, or we invest in gold or jewelry or houses or cars, right? These are all other stores of value. And something like a house stores obviously a lot more value than any single bill or coin can store. The one advantage, though, that money has as a store of value is that that value is perfectly liquid. If you have $20 in your pocket, a $20 bill or $20 in coins, what can you do with it? You can spend it right now. But if your $20 of value is locked up in a car or a house or jewelry or stocks, right? You can't just walk into a store and say, "Hey, I'd like to sell you I'd like to buy $20 worth of goods and services, and here's a tiny slice of my house," right? It's not going to happen. If you've got value in something like a house or a car, you first got to sell it for liquid money, for cash money, for dollars and bills, okay, and coins. So money, it stores its value so long as there's not inflation, but if inflation rises, money loses value. But again, the benefit of money storing its value is that it's liquid. It has perfect liquidity. Anything else, you would have to liquidate it, we would say. All right, so that's what money is. Those are the three functions of money. And now the question is, well, how much money is out there, all right? Well, that leads to a second question is, well, what do we consider to be money? Okay. Now there's different definitions or different ways we can define what is or is not money, and we're going to look at two basic measures of money, two variables called M1 and M2. Now M1 is the most basic measure of the money supply, and it's got three major components. First off, it includes all of the currency in circulation. So that's all of the paper money and all of the coins that are out there in our pockets, in our piggy banks, underneath the sofa. Okay, that's the first component. All the currency that's running wild. To that, we are going to add the total checkable deposits that banks have. So these are basically your checking account balances. Now we consider this, almost as good as money, right? It's not like cash in your pocket, but your checking account is sometimes what we call a demand deposit, which means if the money's in your checking account and you go to the bank and demand it, they have to turn it over to you, which means you can then go spend it. Now today, obviously, it's a lot easier to spend the money in your checking account because you carry around your debit card, which is tied to that checking account. So we're going to add to the currency in circulation all of those checking account balances because, as long as the money's there, you can go out and purchase goods and services. And then the third component of this M1, measure the money supply, are all of the outstanding traveler's checks. So a traveler's check, if you've traveled abroad, internationally, you know that sometimes rather than traveling with a big wad of, $100 bills, you can go to your bank, you've got money in your account, they can deduct the money from your account and give you a traveler's check. And then that traveler's check is almost as good as carrying around the cash. You just have to sign it, write it out to someone, and then you can exchange it for cash or use it to purchase something. And so once the bank has taken that out of your checking account, right, they're not giving you currency in circulation, but that traveler's check, it's basically like walking around with cash. So we're going to add up those three things, all the currency in circulation, checkable deposits, and outstanding traveler's checks, and we add up all of that, and that gives us the M1 measure of the money supply. So that's all of the money that people can go out and spend right away. Okay? Now, we might extend the definition of what we consider to be money. And so we go from M1 to M2. So this is going to consider more things, which means it's going to be larger than M1. In part because M2 is going to include everything that's in M1, so currency in circulation, checkable deposits, traveler's checks, but then we're going to add to that three more components. The first is going to be savings deposits. Now, what's the difference between a savings deposit and a checking deposit? Well, oftentimes banks are going to offer to pay you interest on your savings account. But in order to make sure that you earn that interest, you may be required to keep a certain amount of money in that savings deposit, right? So there may be a minimum balance that you're required to keep, or there may be a maximum amount of money that you're allowed to withdraw from that savings account on a daily basis, so that the bank can make sure it's got some money sitting in the vault, right? So that it can make loans to other customers, which we'll come back to. So your savings deposit, we're going to add that to M1, right? So that means M2, a little bit larger. Also, we're going to include money market account balances. Not going to go into these in any detail, but a money market account is kind of a hybrid between a savings and a checking account. You can, pretty easily tap into it, but again, like a savings account, there may be some other rules that kind of tie some of that money up, so you can't quite access all of it, at any given time. So M1 plus savings deposits plus money market accounts, and then the last thing that we'll add as part of M2 are what we refer to as small time deposits. And these are basically certificates of deposit, CDs. Right? So you can walk into a bank, you can deposit money into a CD, and the way it works is that money goes into that account and you cannot touch it until the end of the term. So a 6-month or 12-month CD, right? That money's locked up. So in a relatively short amount of time, you can access it, use it to purchase stuff, but it's going to be tied up. And it doesn't really sound small, for most people, but how we define a small time deposit is anything less than $100,000. Again, that seems like a lot of money to call a small time deposit, but with time deposits, they typically pay very low interest rates, and so in order to actually earn any substantial interest, it's going to take a lot more money to be deposited to generate more interest. So anything under $100,000 that usually lasts, around 6 months or a year or so, we consider small time deposits, and so we add those to our M2. So we've got M1 and M2. M1, again, currency in circulation, checkable deposits, and traveler's checks. And then M2, we're going to start with M1 and then add savings deposits, money market accounts, and the small time deposits. Now, what is not considered part of the money supply? Well, let's think about this M1. So if you write an equation and you say M1 equals currency in circulation plus checking accounts plus traveler's checks. Okay, so write that equation out. Now, imagine that you walk into a bank and you've got $20 in your pocket and you want to put it in your checking account. Okay, well, you take that money, that $20 bill, out of your pocket and you hand it over to the bank. So now it's no longer in circulation. Okay, so that means M1 has just decreased by $20. But what does the bank do? Well, they're going to add $20 to your checking account. And that checking account balance is also part of M1. And so what that means is M1 goes right back up by $20. So when we deposit cash into our checking account, the overall money supply does not change, right? We get a reduction in currency in circulation, but an increase in checkable deposits, and it cancels out. Well, what happens to that $20 bill, right? Because it's not like it disappears, right? There's an extra $20 in your checking account balance, which is just, a digital, line somewhere and some computer code. But what actually happens to the physical $20 bill? Well, at the end of the night, the bank is going to take it and it's going to put it in the vault, right? And when it's in the vault, when that cash is sitting in the vault, it is not considered part of the money supply because it's not in circulation, and that physical money is already being accounted for on your checking account balance. So when we deposit money, money supply stays the same. When we withdraw money, when you go to the ATM and take it out of your checking account, again, your checkable deposits would go down, but then you'd have more money in circulation. So when we deposit or withdraw cash into our checking or savings accounts, what's happening is the money supply is staying the same in terms of the quantity of money out there, and all we're doing is moving money back and forth. So we're changing the composition, but not the size of the money supply. And that's because vault cash is not considered part of the money supply. Now, another thing to note is that credit card balances or credit cards, the credit available is not considered money, because what's happening is it's really just a form of borrowing. So when you walk into Target and you use your credit card to purchase something, right? You walk out with a good or service. It doesn't hit your bank account, but what's going to happen is let's say it's a Bank of America credit card, right? Bank of America is going to take some money from their account and they're going to transfer it over to the Target bank account. Okay, so that means that you're just borrowing someone else's money, even though you're getting a good or service today, and then you'll have to pay it back in the future. So any credit you have available, it's borrowing. It's not considered part of the money supply. All right, so that covers how we measure the money supply, what's not considered, and then what happens when we put money into or out of our account. So now what we want to think about is the market for money, okay? And we know that sometimes people have money left over at the end of the month, right? And they're thinking, maybe I don't need to spend it. I don't want to just stick it in the piggy bank. Maybe I'd like to loan it out so that I can earn some interest, right? I can take that leftover money and turn it into even more money. And alternatively, there's going to be other people who are like, ooh, maybe I'm a little short this month, or maybe I want to go buy a new house or a car, but they don't have enough money, in cash or in their checking account. So maybe they'd like to borrow some of that leftover money from other people, and then pay them a little bit of interest. So we've got people that are going to be saving money and borrowing money, and we refer to these two groups in the market for money as the people who are supplying money or supplying what we call loanable funds. Those are the people that are saving money at the end of the day. And then on the other side of the market, we have the demanders of loanable funds, the people that are trying to borrow. Now, imagine a world with no banks, right? Because it's when we want to borrow or save money, it's easy. We just go to the bank, easy peasy. But what if there were no banks, right? Let's say I've got $1,000 I'd like to save, and it's $1,000 that I want to try and loan out to somebody. Well, I might ask you guys, all right, anybody need to borrow $1,000? Well, everybody wants $1,000, right? But the catch is, I'm going to charge you some interest. So, I may get lucky and find one person right away that wants to borrow $1,000. Or maybe no one in this class wants to borrow $1,000. So now maybe I've got to go start knocking on doors and say, hey, who wants to borrow $1,000? Right? It's going to take me some time to maybe find one person to borrow all $1,000. So maybe I break it up into smaller chunks. Maybe I loan $100 to one person, $200 to another person. But again, it's going to take me time to loan out all $1,000. All right? So that's what we refer to as a transaction cost, is the time it takes for savers to seek out borrowers. And if I'm trying to borrow money, right? Can any of you guys spot me $1,000? I'll pay you interest. No? No takers? No takers? All right, maybe I'm going to have to start going knocking door to door saying who can loan me $1,000 or who can spot me 100, who can spot me 200. Again, it's going to take me, the borrower, time to seek out anyone that can loan me the money. Now let's say that we find each other, right? The next problem is I don't necessarily know anything about the person that I'm borrowing from or that I'm loaning money to. And so now I'm going to have to spend additional time gathering information. I'm going to do a credit check, a background check, make sure they're not a criminal, right? Make sure that if they have a history of borrowing, that they have a history of also paying it back. That's going to take additional time, and it may actually now cost me money, right? I may have to pay a fee to do a background check or a credit check. So again, we've got additional transaction costs that are being lumped on to that time I already spent trying to find the borrowers or find the savers. Well, let's say that we can find each other. Let's say we gather all the information. The final step, before I hand over the money or you give me the money, is we've got to sign a contract. Well, I don't know anything about contracts. So now we've got additional transaction costs. We may have to hire a lawyer to come in and draw up the contract and then pay a notary to notarize it, right? So again, additional transaction costs. Now the other thing that we've got to worry about, in addition to all these transaction costs, is, let's say I do find one person to loan all $1,000 to, right? I'm putting all of my eggs in one basket, right? What happens if that person runs off? Or what happens if they're, borrowing that $1,000 to start a business and then the business just fails, right? Well, I've lost potentially all $1,000, right? Because I'm assuming 100% of the risk by loaning all of my money to that person, right? Well, what if I break it up and I loan a little bit to this person, a little bit to that person? Well, again, if I'm the only person that person is borrowing from, I'm assuming all the risk, right? Now I'm putting all my eggs into many different baskets, and what if all those different baskets break? Okay, for the borrowers, right? Do I necessarily want to borrow from one person? Because again, what if I can't pay them back? Do I want to owe one person, or maybe do I want to owe different people different amounts? Again, both borrowers and savers are taking on a lot of risk. So what do we do? Well, this is where banks step in. And so we say that banks are playing a role as financial intermediaries. They're basically middlemen, right? And we think of, ooh, middleman, they're always taking their cut. And yeah, they're going to take their cut, but it's because they're going to be providing some valuable services. So the first big benefit we get from banks in their role as middleman, their role as financial intermediary, is that they reduce a lot of those transaction costs. I don't have to go and spend all this time searching for borrowers and savers. I go to the bank, right? I deposit my money or I go to the bank and I get a loan. So that's a big transaction cost that gets reduced. The other thing is, if I'm going to save my money, I don't have to worry about doing all of my own background checks. The bank already has, a department that does all of that, and they're doing that every day, and they've got all that data. They have all that information. I don't have to spend my time and money, going through that information gathering phase. And then finally, at the end of the process, I don't have to bring in a lawyer every time I'm going to save my money and loan it to somebody. the bank has a big old stack of contracts just ready to go. Whether someone's going to borrow for a car or a house or student loans, they're ready to go. This is not their first rodeo. They just grab the next contract and say, all right, sign here on the dotted line, poof, ready to go. Right? So all of those transaction costs get reduced by borrowers and savers coming together in a bank, which is effectively the market for loanable funds. Now, the other thing that the banks are going to do is by having a lot of people deposit their savings and a lot of people borrowing, is that rather than me loaning all of my money to you or me borrowing all of my money from someone, what's going to happen is that we're all going to save our money, and it's going to go in one big pile of money. And when the bank makes a loan, right, they're not going to use all of my money to loan to one person. They're going to use a little bit of my money, a little bit of yours, a little bit of his, a little bit of hers, right? And so what we're going to see is that the risk gets spread out amongst many borrowers and many savers. Okay, so no one borrower or saver is going to be assuming too much of the risk. And then, of course, because the bank is the middleman, if the bank takes our savings and makes a bad loan, well, that's the bank's fault, right? There's, when you deposit your money, it's a demand deposit. It's your money. They're using your money to make loans. So if the bank screws up and makes a bad loan, right, you aren't going to bear the cost of that. They're going to have to pay you back, and it's going to be on the bank, that business, to make up the loss. And that gets us to the last couple of questions we'll cover in this video. What does it mean to have a fractional reserve system, and what is the required reserve ratio? So banks are not new. Banks have been around for a long time, basically since the Middle Ages, where one person says, hey, I'll keep your money safe, and then they simultaneously loan money out. What is relatively new are a couple of features of modern banking. And so one of those features is what we call a fractional reserve system. And so what this means is that when banks accept money from customers, when customers come in and deposit into checking and savings accounts, the bank is going to be required to keep a certain percentage, a certain fraction of those deposits in what we call required reserves. All right? All of the money that the bank accepts goes into the vault, becomes vault cash, but then the bank has to take that vault cash and they've got to put a little bit over here on the side and not touch it. That's the required reserves. And then the rest is the leftovers. That's what we call the excess reserves. And then that's what the bank can then dip into to start making loans to other customers. And the reason we do this is because, a bank is a firm. And at the end of the day, a firm is trying to maximize profit. A bank makes profit by making loans. If you're a bank and you want to maximize profit and you have all these dollars in the vault, it would only make sense to loan out every single dollar that you can. The problem is, what happens if somebody comes in the next day and says, hey, I deposited $100 yesterday, I need to get $20 back. Well, if you're the bank and you've loaned out every last dollar in the vault, you're going to say to them, I'm sorry, I loaned your money out. Well, you can imagine what's going to happen. That person's going to be pretty angry, and they're going to start telling everybody else, say, hey, this bank, they don't have their money, and everybody tries to go and take their money out of the bank. The bank says we don't have it, and the bank fails. And so bank failure runs on the bank. These were not uncommon, for most of banking history. But today we have this rule that says you've got to make sure you keep some reserves actually on reserve. You can't loan out all of your customers' money. And so this required reserve ratio is simply, set by the Federal Reserve, and they say, okay, this year's required reserve ratio is 3%. So for every dollar you accept, you've got to keep 3 pennies in reserve. And that just allows banks to meet that daily demand that depositors have for their own money. Now, the other thing that we see today in the United States and other countries is that, sometimes banks do still fail, right? That fractional reserve system isn't enough to, solve or eliminate every bank failure. And so what we've got is kind of a backstop. And if you've walked into a bank, recently or ever, you've probably seen a little sticker or a sign on the door that says this bank is an FDIC member organization. And what that means is that they are part of the Federal Deposit Insurance Corporation. It's insurance for your bank accounts. And so if you put money into a bank and they're saving it for you and then the bank fails, that FDIC is going to pay you. It's going to be like an insurance payment. Like when someone hits your car, the insurance company pays you, except they're paying you in this case for your bank account. And so the current rules are that every person with an account at any institution that's FDIC insured will be reimbursed up to, I believe the current limit is $250,000. So if you have $200,000 at Bank of America and $300,000 at Wells Fargo, and both of those banks fail, you'll get all of your $200,000 from the first bank, and then in the other bank where you had $300,000, you won't get all your money back, but you're going to get most of it in that case. You're going to get it up to that $250,000. Now, the good news is most of us don't have $250,000 in our bank accounts. But so what that means is, our deposits, the average person, their check in their savings account is insured 100% up to that $250,000. So these two features of our modern banking system, in addition to the banks themselves reducing transaction costs, spreading risk, we have these other features: required reserve ratio, the fractional reserve system, and this FDIC that help to, again, reduce some of the risk and provide some insurance to the people that are just, at the end of the day, trying to save their money and borrow their money.